Never pay your house off in full. And here's why. It's cheap money. Now, a lot of you could say, well, interest rates are rising. I know, but in comparison, it's still cheaper money.
Pay off the house early. Why would I do that?
You've got a house. It's worth a couple of $100,000. It's fully paid for. The equity in that house is a dead asset. The fact that you own the house free and clear isn't helping you put food on the table.
I will never pay off my house. It is a complete waste of dollars. There's a lot more better return you could be getting.
Should I pay off my house?
Never.
Why do you hate Dave Ramsey?
I don't hate Dave Ramsey. I just hate everything he teaches. He's teaching people to be poor because he wants them to take their 40 years of time that they have to make money, and he wants to
Never take money out of your house. The banks have the biggest buildings in the world for a reason. Do not use your home as an ATM.
One of the most important things that I could probably ever tell somebody in finance is the idea of paying off your house. Now, stick with me on this because there are a lot of false information out there. And as a real estate agent, as a self-made person, I'm going to give you my thoughts on this, my uncandid thoughts of what I did to be successful. And you know, you can say whether you want to do this or not, but this is what I did. As a real estate agent, I hear this a lot. Why would I pay off my house when my interest rate is 3% and I'm getting 5% at the bank? Why would I do that? Why would I pay my house off? And as somebody that's paid their house off, I said, let me explain to you about this. And here's what I said. Here are the reasons of the things I say and why. There are a few reasons why you would want to pay off your house. This is not a math game sometimes. This topic really hits home. Let me tell you a story. When I was a little boy, I watched my dad lose everything. He had a business, he signed some leverage notes, and the bubble popped on him, i.e. the term came up and the interest rate exponentially went up. Most business commercial loans are like that. And I watched my dad lose everything. And this was the time that, you know, you don't really understand what's going on. But as an adult now, as a man that's been through a lot, looking back, I realized this is why I don't do leverage. I watched my dad suffer from the blade of leverage. And the one thing that saved our family when the bankers came, when the lawyers came, was having paid for real estate, a paid for house. My dad had the forethought to pay for the house, have it in a homestead, a house and 10 acres. And everything there was safe. And when everything collapsed, our family was safe. And this is the main backbone of my thought process of leverage and paid for real estate. And every time I hear those so-called smartest guys in the room talk, and I realize what a family can go through when it all comes down, the idea of reducing risk was the backbone of my portfolio. Making my family safe first and then working out from there. You pay the money off and then you go make more money. I used the amount of money that I could spare for the house and for a good solid fighting position, and then I took the rest of the money and I invested it. Okay? And yeah, this first house I bought with a loan. I paid it off within like 6 months. But I learned the process of buying with a loan, what the bank does, how it all works, insurance. And I wanted to learn that process, but I immediately paid it off because I realized I was now going to live in the house. When I bought it, it was a rental. I realized that now I'm going to live in the house. I realized what I was eating in interest. I said, this is going to be my paid for real estate, and I paid for it. And I reduced the risk of my family. I was starting a family at the time, and I realized we need a place to live no matter what. And that is so important to me. A lot of the times when I see these guys, these smartest guys, smarter than everybody else, and they say never pay off the house, I see they're usually young men or women that have not seen enough of life yet and the things that can happen in life, like bankruptcy, losing everything, business not going the way it's supposed to, pandemics. And they have not had those situations to teach them, hey, let's not take on so much debt. Let's not have so much risk. Let's not hope the insurance company doesn't raise their premiums on all 30 of my houses, or let's, keep taking that risk. Because honestly, a few years ago, everything should have gone bankrupt. The government stepped in and bailed it all out. Those situations, it can make you homeless. And those are the things you realize real quick.
Pay off the house early. Why would I do that? And the reason is very simple. As we've studied millionaires over the last 25 years, and the two primary things we see that those habits that cause them to be successful is 401k and a paid-for house. Now, the paid-for house not only is going up in value and stabilizes, but we do not find them saying, I'm going to borrow as much 3.5% money as I can borrow because I can invest it and make a better rate of return. We find them getting the house paid off and using the increased cash flow of not having a house payment to then go bananas on their investing, and their 401ks and non-401k investing starts to go through the roof.
In the Southeast, and just in general, if you live in California, with the fires, insurance is one of the most painful parts of owning real estate, okay? And insurance cost goes up. It just goes up. And sometimes it goes up the next time you buy your premium, or you just get a letter in the mail and you get dropped. Well, as somebody that paid off their house, you are able to control insurance on your house, okay? As a person that's paid off my house, I don't have to have insurance if I don't need to. I could have just fire. I could have only a cash policy. I could structure the insurance that I want to make sure that I am not held to the bank to have insurance. And when you have a mortgage, and you have to have insurance, and you have to have a certain type of insurance that the bank wants you to have. So if you get dropped, they will just force place the insurance on you. So your payment can go from, like you're trying to say, very little, your 3% interest. Let's say, let's round it off, $1,000 a month. But your insurance triples. That's happened to quite a few of my friends. They got force placed. The bank gives them a $15,000 a year insurance policy. Their monthly payment skyrockets because it's escrowed. Most people escrow their insurance. It skyrockets. And all of a sudden, they're looking at $1,500 a month for their payment every month. And all of a sudden, you're looking at a situation you might not be able to afford your house. And you miss so many payments, your house is gone, okay? So the risk factor of being foreclosed on because your insurance tripled, like let's say you had a bad wiring, or you had old wiring, or old plumbing, or a bad roof, or all these maintenance requirements that you can't afford right now, and then they drop your insurance, you get force placed, and all of a sudden your insurance goes through the roof, and let's say you bought it at a time that you didn't get homestead exemption and your taxes go up, or you bought a new build and your taxes go up, okay, and you weren't planning on that, all that was escrowed, and your payment goes from $1,000 a month to $1,500 a month, or $2,000 a month. Major problem. Do that long enough, you get foreclosed on. And you're like, oh, well, I've got money in the bank and it's getting 5%. Well, I can just use that. The thing I'm trying to tell you here is the risk of losing your house. Most people that get foreclosed on had a mortgage. So the way to reduce risk in life is get rid of the mortgage. So further on with the risk, most states have homestead exemption. Not a lawyer, but I'm just telling you the way I think. The way I thought about it was, if I have homestead exemption, I'm protected from a creditor or a medical bill or whatever. As it being a homestead, I know that if my house is paid for, the money that my house has involved in it is protected from litigation. You have a major surgery, cancer, you're older, you get a big medical bill, and you're staring at a judgment for all that money that's in the bank, but they can't take your house and the money in your house, right? If you've got a non-paid for house, but you got that money in the bank, that money's toast, and here you are staring at still a mortgage. It feels really good if I had a really bad day to come home and know that no matter what, these walls are still going to be mine. All I got to do is come up with the taxes. And if you've got a homestead exemption, like here in the state of Florida, your taxes are going to be much lower because you have homestead exemption, or you have other exemptions like being a veteran, et cetera, et cetera. Many things to think about. The reduction of risk in your life. Peace of mind versus risk. especially if you have a career that has a high litigation risk. Okay, like I said, I'm not a lawyer, but if you are sue prone and you haven't paid off your house, I don't understand why, because you can always refinance out and get the money if you need, but that money is safe, and odds are it's going to be safe for your inheritees or the people that inherited it. I just had a conversation about this with an attorney on homestead exemption, and you really need to look at how you can protect your assets through that homestead exemption and the money that you paid for your house. Another thing, when you see people say never pay off the debt, usually behind them's a bookshelf and they're selling their book. And there's more people out there that have mortgages than that are paying their house off. And when you factor in the bankers wanting everybody to keep their notes and not pay off their house, you realize maybe there's a little something behind them saying don't pay off your house. Maybe there's an agenda. And that doesn't make it correct, because everybody keeps puppeting the same exact thing. It doesn't make it correct. Carrying less debt on your balance sheet is always a good thing. You pay down debt, so don't always listen to what you hear on TikTok. I always say, let me see their financial statement and I'll decide whether I want to listen to what they have to say. Most of those young guys out there that are parroting this stuff, if you actually looked at their balance sheet, they're not worth anything. When they say they have $1 million, it's usually leveraged to the hilt. And after you factor out the debt, they might have $100,000. So look at who you're getting the information from. Are they wealthy or are they not? And I've realized that when I talk to these cats and they've syndicated all these deals and all the 150 units they own 2% of it, 5% of it. But on their top title, it says, $1 million portfolio, multi-million dollar portfolio. Look how much debt is on those books.
Listen, man, do not pay off your house. If you're paying off your house, you're basically, with the cash you're using to pay off your house, you are making 3%, 4%. Can't you make more on your money? If you can just put it in the stock market and make 7% and not into your house making 4% or 5%, why would you not do that? You're making 3% net, depending on the spread there. Put your money into something else like real estate.
So let's talk about the aggregate, okay? People want to talk about, I'm at 3% here and I can get 5% here. Well, you're not going to get 5% here. Interest rates are going down, so that's only going to last so long, okay? You have a known rate of return you can pay down over here of 3%. And you're saying, well, I can write this off on my taxes. You're not winning there. Risk, the delta volatility, it's peanuts, okay? The peace of mind is worth way more than the delta of this.
And I can put it in a S&P 500 and make an average of 11 or 12. Why am I not making that spread? Well, you left out taxes for one thing. The second thing is you left out risk. And you left out what? Having a mortgage on your personal residence where your kids and your dog and your spouse live, how much you carry that physically in your body. It's real. When you don't have a mortgage, you don't have a mortgage payment, and we have a Fauci quarantine, it's a different thing. You don't have a problem. You don't have the same sense of stress. You don't feel it across your shoulder blades and down your back. And people get so used to carrying the weight, they don't realize they're walking around with this backpack with weights in it.
And you say, oh, well, I can get 10% in the S&P 500. You can't look at rear projections and try to judge where something's going to be in the future. We could have multiple down years. We could have a time period of very little growth or negative growth. You can't say that in the future it's still going to get 10%. And you got to factor in inflation, taxes on that, the delta risk variable. It's not what you think it is. Like, it's not basic math like you think. If you're looking at 5 minus 3 and you're getting a 2% return, no, you're not. You're still going to pay taxes on it. You're still going to have the risk. You're still going to have the delta. I'm just trying to say that the most important thing you can have is a safe place to sleep that's protected from being sued for it, and the money is sitting right there. And if the bank system collapses, the house is still there. Okay, like I have seen people, and this happened to me. Our bank accounts got hacked one time. It was going to take 90 days to get that money back. And if you're paying your mortgage out of that money, well, you're going to be way behind in 90 days, or your car payment, or any of these things. There are multiple ways that it can come back to haunt you. This is not, oh, well, the bank, it's protected, it's FDIC insured, it's all this thing. I did a video when we got hacked, and the situation it created to where, Samantha couldn't pay her car payment. She couldn't pay, many of her things because her bank account was frozen, and it was going to be frozen for 90 days. All her money was frozen. It was one of the most terrifying events for her because she didn't know what to do and never thought that might happen. And you've got to fight the bank to get your money back. This is not you just get your money back, okay? So think about that when you're sitting all the money over there and you're like, well, if I lose my house, where am I going to sleep? If my office is at my house, where am I going to work? Lots of problems created there. But trust me, you're talking to a guy that took on all the risks in real estate to make my money. I crawled under the houses. I bought old nasty houses. I took the risk. I put my money out there and expected to take a haircut. And this is what I realized through all that, okay? Like, don't bet the house, okay? You pay your house off first. Because if you're going to take a $50,000 haircut or a $100,000 haircut, you want it to be on something out there, not at your house. You want to reduce the risk as much as possible, because I could have lost hundreds of thousands of dollars in the adventure that I took buying, fixing, flipping houses. Eventually, you're going to hit a landmine, and that's any investment. The risk is there. I was taking massive amounts of risk to make massive amounts of return, and that's not for everybody. Not everybody can do what I did. Not everybody gets lucky. I don't think I was lucky. I did my best, but I took my chances. That is something you have to ask yourself when you're on that adventure. I've seen a lot of people fail. I've seen a lot of people lose money in real estate. It's just not something that just everybody wins on. That's investing, period. That's why you get a high return when you take a lot of risk, and you don't take a lot of risk if there's no high return. So trust me, I took the risk. I did all these things that I'm telling you not to do. Just don't do it. Pay your house off. Take a slow and steady approach and save your money. And if you've got extra money to go buy and flip houses, go do that. But don't bet the house. Don't leverage the house. Don't take HELOCs on the house. Your family needs a place to stay, live, eat, and you need a place of peace of mind, protection from the outside world, whether it's big or small. And as you get more wealthy, as you go up in wealth, you can change your homestead from a small place to a big place because you're trying to protect more value. And I think in the state of Florida, a house 10 acres is high as you can get. I'm not quite sure. I think that's right. Put a big mansion, 10 acres, protect it. Put all that money, pay that off. And you've got some protection. But not a lawyer. I'm just telling you my opinion, my thought here. There's ways to do it. But when you're getting your advice from TikTok and YouTube, and I know you got to get advice from somewhere, those guys are not doing it. Like one hiccup in their portfolio and they're in bankruptcy court. So you do this slow and steady, methodical. You have a plan. And the reason why Dave Ramsey, he tells you a plan. There's lots of ways to do it. I did it a different way. But for most people, that will be a good plan. And then you can adjust fire from there. Pay your house off. Go for it. Do whatever you want to do. Do owner financing. Open a pawn shop. Do whatever you want to do. But that first step, things you got to have in life. Paid for a car, paid for a house. Your life's your oyster. Then the rest is easy. Next situation, okay? This is one thing nobody covers. There's a big difference between having $300,000 paid for in a house or $200,000 and having $1 million. Okay, now let's look at the different situations here. And as a real estate agent, I understand this very much. I took my money and paid off a house that was, I bought my house very reasonably. I bought it for $70,000. I had to renovate it, yeah, and I paid it off. Now, I took the rest of my money and I bought more houses and flipped and renovated and flipped and renovated and bought businesses and did that kind of stuff. My capital, apart from what I had, I used above and beyond to get a return. I didn't put all my capital into a house. And I feel like this is where some of this breaks down. People are like, oh, well, you know, I can get 10% in the S&P 500. Yeah, you can. Don't buy $1 million house. Buy one you can afford. 300,000 or 400,000. You still got money to invest and to maneuver with and jump on things that come about that you might could get a great return on with that cash. Okay, cool. And then you've still got the peace of mind of having a paid for house. Just don't buy too big of a house. I've always said that big houses are built for the banks because they want to lend those notes on those properties and they want somebody to pay for those properties. Now, most people wind up buying a little house and then a bigger house and then a bigger house and a bigger house. And then when they get to be 60, 65 and they want to retire, they sell the big house and they buy the little house. I'm like, well, you could have just kept the little house to begin with and just, you know, moved on up the chamber by having the extra cash. So buying too big of a house and paying off too big of a house sometimes is that part of the conversation a lot of people don't want to talk about. And that's one thing that I wanted to throw in to make sure you got to think about how much money you're putting into an object that's still just a place to sleep. I know a lot of people say, well, I want to enjoy my home. Well, you can enjoy a normal size house paid for and then go and do other things with your money. Go buy a mountain house. Go buy other type of real estate. But just having one property that people say, oh, I'm just, you know, having the cost to maintain it. I'm, you know, it's not an asset because I'm spending money to maintain it and property tax. I'm like, yeah, but you got to live somewhere. Just don't spend too much money on it. That's my thought on that.
Never take money out of your house. People do it all the time. They take money out of their home, this equity line of credit or a home equity loan. When you do that and you take and buy a car, pay off a car, pay off your credit cards, and then 2 years later, you're trading in your car. Now you got another car payment. Now you got a second mortgage payment on top of your first mortgage payment. The point I'm trying to make is this. The banks have the biggest buildings in the world for a reason. Do not use your home as an ATM. You want to make sure that you have that money in that house whenever you go to sell it, or for God forbid, you need it for emergency purposes only, and that's a life and death situation. Other than that, do not pull money out of your home. I don't care what anybody says. Do not pull money, cash, out of your home through an equity line of credit or home equity loan. Been there and done that. I've seen thousands of people do it. You've probably done it. You know exactly what I'm talking about, and you probably regret it. Never.
Another reason a lot of people pay for their house is cash preservation. Okay, let me tell you this. With the wealthy, when you have millions of dollars, you don't put that all in the bank. Okay, you put it in something. You know, you exchange dollars for a thing. Go and look at a lot of the houses on the beach, okay, or high-end luxury, or high-end condos. A lot of times you take $1 million out of the bank because FDIC over a certain amount doesn't exist, you know, usually over 250, or with a husband-wife 500 or 750 if you can structure it certain ways. But over that, there's no protection on that money. Take that money out, you buy an expensive item, i.e. beach house or investment house or rental property, and you put that money out of the banking system and into a piece of brick, piece of dirt. Okay, and that's how you do it. You put your money in these items, and a lot of people don't trust the banking system because you can get hacked. You could have a down network. You could get frozen out of your money. A lot of things, and a lot of rich people will take large sums of money and buy big ticket items. And a lot of these guys aren't telling you that because they don't have clients that have a lot of money, or they don't have a lot of money. I've experienced it myself. I can't keep opening bank accounts. I have to buy something big to hold, you know, the value. Especially in an inflationary market, you want to own things and not cash. So that's why everybody bought real estate. All the investors went out and just bought as much real estate as possible. And a lot of them paid it off. Because when you're dealing with a bank and you're trying to buy real estate, they'll keep you from buying certain things that you want to buy. Can't get insurance on it, can't close the loan. Okay, so sometimes you fire it off with cash, you get speed, you get better deals with cash. Trust me, Guys like Chris Crone and all those guys out there saying, oh, never gonna pay it off. Why would you want to do that? They're selling books, selling courses. Okay, if you looked at their balance sheet, you would find out they made their money by talking, not by having money. And a lot of them don't have money, especially these tax gurus. Don't get me started on those. So that's my thoughts on it. I hope this made sense. I've done a lot of videos on this. And the way I look at it is I want to reduce the risk in my life. I want to always have a place to sleep. I want some stability to safeguard my money. State of Florida, homestead exemption. It's pretty protected, except for I think the IRS and maintenance or service loan or liens in your mortgage, right? So, if you've got a mortgage, they can take it. Those certain types of, IRS judgments, things like that. But the average medical bill of you getting cancer and you're worried that you're going to lose your house, the peace of mind is just so big that that your house is still going to be there. If you're trying to play the aggregate, this is the difference in the aggregate. The peace of mind formula. Google that. It's very interesting to say, how can I sleep at night? What makes me feel good at night? What makes me want to put my head down on the pillow and feel like I'm not waking up stressed tomorrow, that my family might not have a place to go? If I had the money sitting there, I would just go and solidify that question. And once you have your house paid for, then you can be very aggressive with your money. Everything's taken care of. I don't have to worry about, if I want to take a risk on that business that my family's going to be homeless. I can take that risk on that business, and my fallback point is my house. And ever since I've done these rules, these things that I've told you about, I've stayed up many a nights thinking about this. And ever since I've done this, my wealth went up very fast. It was crazy what the peace of mind did to me, wanting to get into other things that exponentially increased my wealth. Okay, Dave Ramsey was right about this when he said that usually when people pay off their house, their net worth goes up quite a bit after that. It's not a mathematical thing. It's a peace of mind. I'm operating from a position of F you, okay? If it doesn't work out, F you, I'm going home, my house is paid for. If they make fun of me at work and I don't want to be there anymore, you know what? I can go home. I don't have to take that job. You're not going to speak to me like that. You're not going to do these things to me because I'm going to go home. And when one of the worst real estate markets in history happens and you don't sell a house that month, not that big of a deal. You're not worried about losing the house. You know what I'm saying? So these are the things that you build the fortress of finance around you that you're taken care of. And if your wife wants to quit her job, she can and go do what she wants to do. And sometimes that means starting a business and making more money than where she was before. I hope all this stuff makes sense. Comment down below with what you think. Does this make sense? Does it not? And don't just say, oh, well, you lost me at Dave Ramsey. Well, Dave Ramsey is a very wealthy man, and he took some principles and he put them out there just like this and said, if you want to win, here's a game plan. And if you follow these rules, you'll be pretty wealthy. Are you going to be the wealthiest? Probably not. That takes a lot more risk. But this is a game plan to win if you don't have a game plan. I followed that game plan. I won. Now I'm in another game plan. I can play a different set of rules, and it's helping me a lot. And as somebody that is debt-free and not a worry in the world, this is how I did it. Pay off your debts, live on less than you make, have some peace of mind, don't do debt. It's the way to lose. If you got a credit card, pay it off every month and collect the points if you want to. If you're bad with discipline of paying it off, don't have one. Simple. I've learned with a lot of this stuff, especially in real estate, more moving parts, the worst. If you've got a lot of bank accounts, a lot of credit cards, got a lot of different LLCs, it's a situation for failure because you've got to maintain all that. And that robs me of my peace of mind. I just want 1 or 2 credit cards, 1 or 2 bank accounts, tax returns easy, and I'm going to the beach. That's the way you want to be. Write checks, cash checks, go to the beach. See you guys in the next video.